Okay. Alright. Okay, I'll start. Good afternoon, ladies and gentlemen, and welcome to Siloam's third quarter earnings call webinar. We hope everyone is doing well. And my name is Willy Chandra, and in today's webinar, I'm joined by Pak Farun Kana, Siloam's Managing Director of Healthcare Business and Investments, and Pak Daniel Fa, Siloam's Group CFO. The webinar, as usual, will be divided into three sections. First section is the delivery of financial and operational results by Pak Daniel Fa. Second section is the delivery of Siloam's business update and strategy by Pak Farun Kana. And lastly, we will open up the floor for Q&A. For participants who want to ask questions, please use the Q&A function in your Zoom screen and feel free to ask questions during the sections. If you wish to speak directly to the management, please use the raise your hand function and I will enable you to speak. And without further ado, I will pass on the floor to Pak Daniel to bring out the financial results.
Thank you, Willy. Before we need to get the results on screen, I'm very excited to share with you the three-quarter results. Yeah. As you may have seen from the numbers that's been published. Sorry, just wait for Willy to. Willy, can you get to the results slides? Yes, if you look at the revenue, EBITDA, and net profit that's been published, this is a record quarter for us. Yeah, in terms of a 3Q2023. Revenue of 2.3 trillion, EBITDA of 741 B, with a net profit of 367 B. Now, this is phenomenal, not just simply because of the numbers that was printed, but more that of the fact that this is built upon 5 quarters of sustained quarter-on-quarter growth post-COVID. Yeah. So if you were to look at, let's say 3Q22, that was really the first kind of a post-COVID quarter whereby we were moving out of the shadow of Delta, of Omicron, and we were moving out of the shadow of the effect of Lebaran. Yeah. And from that on, you have seen quarter-on-quarter revenue, EBITDA, net profit. The company has seen sustained growth momentum. Now, I've seen a lot of questions being asked during previous presentations as to, look, is this sustainable? Is it pent-up demand? Is it negative medical tourism? Is it seasonal factors? Is it because Singapore hospital is too full and therefore people are still coming to your hospitals? I would really say, look, lightning doesn't strike twice in the same spot. It is unlikely that it will strike 5 times consistently. I hope that by the fact that we're able to deliver this 5 quarters of sustained quarter-on-quarter growth, that is enough to provide evidence that really this is based on robust, really no magical fairy dust, and there's no silver bullet. This is based on diligent execution of the Siloam 5.0 strategy, diligent execution by all hospital directors, nurses, and doctors in regard to making sure that we give our patients the highest care possible in order to deliver the results that you're seeing now. If you look at, for example, we give as a reference the 4Q19 result because that was really the final pre-COVID season, if you like, because 1Q20 is that affected by COVID. You look at the EBITDA for 4Q19, yeah, we are now basically 3 times higher in terms of our EBITDA in 3Q23 compared to 4Q19, yeah. EBITDA 3Q23 versus 3Q22, quarter-on-quarter is a close to 30% growth. If you look at the full year, is a close to 40% growth in terms of EBITDA. Net profit is even more significant, a 50% quarter-on-quarter growth, and 93% year-on-year growth. We are very excited with these results. I think, as mentioned, more so than anything else, this confirmed the fact that the Siloam 5.0 strategy that management has put in place since 2019, that was obviously disrupted by COVID, is now bearing fruit, is now reflecting in the results that you're seeing in front of you. Now, next, let me talk about how we were able to deliver these phenomenal results. My dear colleague Varun will talk a little bit more about what we've been doing on Congo, our key craft group that we've been developing. But another key point to outline is that if you look at our revenue intensity, that has continued a sustained growth from 2019 up to now with a CAGR of 15% year on year. Compared to our peers, you will notice that our revenue intensities, either on a full year basis or on a quarterly basis, is close to doubled what the peers are doing. And this, I think, is very important. This was also basically based on the Siloam 5.0 strategy of focusing on high complexity cases, on building up center of excellence in our hospitals, in ensuring that we get the best specialists that we can in regard to the clinical programs that we provide. That has reflected, if you can see from the next slide, in the operational results, whereby be it inpatients, outpatients, emergencies, OPD to IPD conversions, you have seen sustained quarter-on-quarter improvements. Inpatient days improved by 9% from 3Q2023 to 2Q2023. Inpatient admissions improved by 12% from 3Q2023 to 2Q2023. Average length of stay have been managed steadily downward. Now, for those of you not from the hospital industry, we aim for shorter average length of stay instead of higher length of stay. Outpatient visits is up 15% quarter on quarter. Occupancy rate is sitting at a phenomenal 68.2% in 3Q of 23. And I think what you will see is that a company has not improved, has made improvement not just in its operations and in its revenue. It has also made very concerted effort to improve margins, as you will see in the following slides. Again, we have provided 4Q19 for reference because that was our last good quarter before COVID. If you can look at the various parameters that's been presented here, drug and clinical supplies as a percentage of revenue was 35% in 4Q19. It is now 28.5%. Operating expenses in 4Q19 was 36.1%. It is now 28.8%. EBITDA margin has improved from 18.4% in 4Q19 to 32.4% in 3Q23. Net profit margin is even more phenomenal. We were looking at a 3.2%, I mean, barely basically breaking even, to now making a very healthy 16.1% net profit margin. Now, as you can see from the trend graph that I'm presenting here, quarter on quarter, you see a clear trend of expenses dropping as a percentage of revenue. You see a clear trend of EBITDA margin improving quarter on quarters. Now, a few of you has asked me, especially coming out of COVID, right? What sort of EBITDA margin would you be looking at? If you saw during COVID, for example, in the COVID period, we were doing about 25% EBITDA margins. And I was telling you, look, we will be aiming to do at least 25%. You have seen from really the last 5 quarters, we have consistently beaten that, and we are performing at really 30% EBITDA margin. And 3Q23, we have gone above 30%, and we are now doing 32.4%. That is not by magic. That is not by accident. That is not by one-off events. That is not by some magical blessings that happen. We work hard on it year on year. And if you can look at the next slides, we have worked on various savings on medical equipments, on material costs, on procurements. Some of these are reflected in OPEX. Some of this is reflected in CAPEX. Some of this is reflected in material costs. But 9 months 2023, we have realized 120 B of savings in 9 months 2023 alone. Now, 840 B of saving has been identified for the next 5 years, for which we would realize. But we are still working on various initiatives. I think I have spoken to all of you about the various initiatives we've been conducting, for example, on material costs, trying to consolidate the volume, on trying to look at OPEX, on how we can rationalize our nursing pool better, on how we can optimize our contract and equipment services. I want to say we are not done. We are definitely not done. We have achieved significant improvement on our margins, but we still see that there are room for us to do better. And we do see that there are opportunities for this to move further going forward. Other than efficiencies, and margins, we have also been working hard on improving our operational cash flow. Obviously, cash flow will improve as a result of improved performance. But beyond that, you will see that working capital days is now the lowest it's ever been, sitting at 8 days, compared to 1Q22, where it was 40 days. You will see that all metrics that is been shown here, inventory days have been steadily decreasing from 49 days in 1Q22 to 30 days now in 3Q23. Receivable days have been dropping steadily from 61 days down to 42 days, and payable days has remained largely stable. And again, these are an area that management will continue to focus on. We do believe that with the cash that we are generating, we need to be prudent in optimizing the amount we spend on working capital so that we can spend more on investing, on equipment, on beds, on opening new hospitals, and on improving the clinical care that we provide to our patients through continual investments in IT, in patients' experience, and in clinical excellence in all that we do. So that is all from me in terms of the financial results. I will turn the time over to my dear colleague Varun to talk about operational matters and some of the things that we've been doing to achieve the phenomenal result that we are showing you today. Over to you, Varun.
Thank you, Daniel. So before we kind of get into the specifics, I think I again like to give some color on the market so that we leave everybody favorably biased towards the healthcare market in Indonesia. So currently the market size, as we all know, is about 270 trillion. And this 270 trillion, 63% of this is really in the private space. Daniel spoke about our strategy, and I'm sharing these numbers because these do matter in a very significant way in terms of how we decide and work on our strategy. When we look at this market and 5 years back as well, we always used to believe that the premium segment of the market is getting underserved. Over and above the 270 trillion market that currently prevails in Indonesia, almost $5 billion actually goes abroad. And there's no reason for people to get care outside of their country. So we've been firm believers that if you're able to bring the complexity, care, and the experience in Indonesia, more and more Indonesians would want to stay home. So let me also give you a sense of what the market currently is. So if I split that market, the 63% private market, our assumption is 40T is the premium market, 100T is the value market, and 40T is the BPJS market. All of these segments of the market are continuing to grow. So the blended growth rate of the market is 6 to 8%. And the growth rate within these three elements, you'll be surprised that the premium market is actually growing slightly over the value and the BPJS market in Indonesia. Our focus has been to be able to cater to all three segments. And that's how we spoke to you previously about our archetype approach. So we are now looking at three segments of the market, looking at the premium, the value, and the BPJS. And you understand that we have 41 hospitals, and not all of them have the same value prop. Each one of them would have or stand for their own value proposition. And we segment those value props into the three categories that I just spoke about. Another big trend that continues to be very, very favorable, our partnerships with our corporates and insurers have only got stronger. I think this is the first quarter, Daniel, Willie, where we've actually gone in excess of 50% of our business coming from the corporate and insurance market. The good part about this market and this business is it's very, very sustainable. It's only got stronger. I remember in 2019, we used to be at about 30% coming from the private and the corporate and insurance market, and we now look at in excess of 50%. From a payer contribution standpoint, we've again proven through our numbers over the last many quarters that we've been able to maintain our payer mix, wherein almost 80+%, 82 to be precise, is actually coming in from OPE, corporate and insurance business. And the balance 18% is really the BPJS market, which we continue to serve as well. Another piece that I want to touch upon is the Q3 numbers that Daniel spoke about are largely driven by volume increase as well. You see our throughput increase across all segments has been very, very significant. When we look at these throughput increases, we are also mindful that we need to be able to grow throughput in Congo. And this is a new term that you're hearing from us. Willie, if you can get to the Congo slide. Congo, so we've been speaking to you about our complexity in the past as well, and we continue to work on complexity. Some of you have been asking us, how do we look at complexity? Where does the complexity come in from? What are the centers of excellence that we are focusing on? So we're making life a little simpler for you to understand what our Congo mix is. So Congo is largely cardiology, oncology, neuro, gastro, and orthopedics. To give you a sense, we used to be mid-20s in terms of the Congo contribution to our overall business. So we were largely medical focused about 5-7 years back. As we speak today, our Congo contribution to the overall business is about 40%. And what is interesting is that we've done so much work in terms of putting the talent together, getting the right technology to be able to serve our patients on these craft groups, and of course, have the relevant infrastructure. All of this done right is actually showing us significant trends on volume on Congo. So you see that even through the year, and when we come up with the annual results, we will give you year-on-year comparison as well. But this year, we're showing you that even on a quarter-on-quarter basis, we are continuing to grow our volume in each one of these complex clinical programs that we run. So this is a breakup of cardiology, onco, neuro, gastro, and orthopedics. You'll also see that our numbers on gastroenterology compared to some of the other categories within the Congo space are things that we need to enhance, as a share of the market doesn't seem to be too high on Congo. Share of the market doesn't seem to be too high on gastroenterology, while Congo is extremely high. On the oncology market, we continue to lead the market because what we've been able to develop from a patient perception standpoint, I think, is unmatched in Indonesia. So we're very proud of the work that we've done there, and we continue to drive clinical outcomes in oncology, which is globally benchmarked. You will see and hear more from us on gastro as we are enhancing our gastro focus, both from a clinical talent and technology standpoint. Willie, if you can go on. One of the things that I want to touch upon is every time we talk about our digital initiatives, but I really want to step back and tell you all, why have we been so focused or laser focused on what we have done on the digital side? When we look at the mega trends for healthcare in Indonesia, we try and see that what's changing, right? So apart from the senior population demographics, there is a very significant increase in the digital penetration in this country. We are seeing that the digital technology adoption rate in healthcare has actually changed quite significantly in the last 5 years. There is a very significant digitization too that's happened in healthcare, and there are 3 elements that we look at. The first one is something which is very easily understood. That is the digital infrastructure piece of it. And we've spoken to you about it earlier as well, that we today have digital infrastructure which is unparalleled. Any other hospital chain in Asia, we are comparable to the West. The second part is digital patient channels, and we've spoken about DPC quite significantly in the past as well. The third part is something that hasn't penetrated in Indonesia as much and currently is more prevalent in the Western world, is how do we deliver care digitally? And we've been razor focused on all 3 of them. Today, our EMR compliance is 97% across our network. If you look at what we've been able to do with that, for those of you who use our app, and we always say that you should use our app is more like a super app on healthcare. What can you do on the app? You can do bookings on the app. You can register, you can check in, you can pay, you can look at your medical records. And when I say medical records, it's a single source of truth. Whether you go to a hospital in Kupang, our hospital in Kupang, or you go in Jakarta, you will be able to access your medical records irrespective of which Siloam hospital you go to on your app. When I look at my own app, I'm able to see my history for the last 2 years, 2.5 years on my app page. Now, that degree of transparency really keeps the customer come back to you again and again, because that's what you want. You don't have to carry your history. You can have it digitally accessed, and you can share it with any doctor in Siloam at any point in time. So that digital infrastructure has really started to pave a lot for us. It's providing us a lot of opportunity. We've shared with you in the past, and this quarter is phenomenal. We've shared that more than 20% of our business now is digitally acquired. And if I show you the numbers for this year, we've done more than 500,000 bookings through our digital patient channels, and which means about 25% of our business on the OP has actually come through the digital channels. We are very hopeful that this percentage will continue to grow, because what we've seen in terms of access to our website, and let me share some numbers on that as well. Our website used to get about 250 to 300,000 hits every month 3 years back. And you'll be surprised. I mean, our best that we've touched now is about 15 million. And on average for this year, we're doing 12 million hits on the website per month. Why is this grown? Because one, there is service convenience. You can interact with Siloam through the web pages. And second, we are the information repository for this country. The amount of content that we have in Bhasa, which is now loaded on our website, could potentially answer most of your queries that you will search Google for. And that's the reason we are getting these kind of hits. Needless to say, as we get these kind of hits, there is a lot of conversion also that starts to happen. So I think our digital endeavors over the last, and the investments that we've made over the last 3 to 5 years, are now giving us significant returns. And in a way, I feel this will continue to grow. Go on, Billy. Yeah, so that's largely it. I think the results are encouraging. Some of you have been asking these questions in the past as well, in terms of how we see going forward. We don't give guidance because Daniel generally tells me not to leave you with any numbers. But we can say that as we see the business for this month, we are very hopeful that we will be able to continue our profitability percentages. And I don't see any reason why our growth rates over the last 9 months will not continue in the fourth quarter as well. So with that, I'll pass it back to Billy. Thank you.
Okay, thank you very much, Pak Farun. Before I open the floor for Q&A, Pak Daniel, do you want to take them through to our ESG achievement?
Yeah, sure. Let me talk a little bit about, look, Siloam is always a strong believer in giving back to the community, and has always heavily participated in the various CSR program. But one of the very exciting program I do want to talk to you about is the Selangkah program that we are launching, which stands for Semangat Lawan Kanker. So look, oncology is obviously one of the key focus groups that we are working on in terms of the clinical programs. And we do believe that it is an area that could still see substantial improvement, and especially there's a lot of underprivileged groups that do not have access to quality cancer care services. So the Selangkah Lawan Kanker campaign this year focuses on breast cancer. In fact, if you notice from the shirt that Willie is wearing, it is pink. It's to go along with this program. But unfortunately, I couldn't find a pink shirt in my wardrobe. I'll try to find one later. But it is a very important program. We have helped close to 7,000 women through the donations that have been made by the over 193 groups. And the program has been pushed out through to 48 villages. And this program is supported by mammography equipment available in 14 of the Siloam hospitals. And we have a target of being able to reach 25,000 women over time through this program to be able to have access to early screening and therefore early preventive care to breast cancer. And along with that, we've also basically had the Run for Hope that was launched in MRCCC. It was a very successful event attended by 3,000 people from various industries and groups. And this is a very key program that was put on hold temporarily during the COVID period. And we were very happy that we were able to do this year on year now. And that we have received a lot of very positive coverage on it, and along with donations that could then be used towards helping push out the cancer treatment for less privileged group. We also have a very strong focus on our ESG. We were very privileged to be invited to the Indonesia Sustainability Forum in 2023. But we signed the Sustainability Pact as part of the agreement to outline our commitment to pursue sustainability, which basically covers 7 pivotal commitment areas that cover a range of areas in sustainable healthcare, and making sure that we continue to drive innovations in healthcare technologies as well. So all in all, I think an excellent quarter. I mean, built upon a sustained program that management has executed. I hope Varun has given you further light as well on the operational side as to how we were able to achieve these results. CSR and the ESG will continue to be a key focus areas for Siloam going forward. With that, I think I'll close the formal part of management presentations and open the floor to questions from the analysts and those who are present.
Sure. Thank you very much, Pak Daniel, Pak Varun. And I would also like to remind for participants who want to ask questions, please use the Q&A function in your Zoom screen. And we already have one question here, Pak, from Ismail, BRI Dana Reksa. The question is, can we know how much the contribution to revenue coming from private insurance, including the corporations? Also, how much percent of the revenue coming from the biggest private insurance?
So I think we would not like to share each specific insurer. But what we can tell you is that our insurances are our insurance business is well spread across multiple insurers. So we work with about 100 insurance companies, and our top 20 insurers would probably give us about 65 to 70% of our total insurance business. So it's the dependence on any single insurers is not too high.
Thank you very much, Varun. We
Hope that
also
answers the
have
question.
Robert on the line. He is raising hand, so I will allow Robert to talk.
Yeah, hello. Congrats, Pak, for the superb results in this third quarter, Pak. I just want to ask on why your Congo IRPD increased Q on Q, and is it more towards cash mix, or is it because of the volume? And is it going to sustain in the future? And my second question will be, can you share your progress and performance on your ramping up hospital? How many more ramping up hospital there is still in a net loss position, and which hospital, and the strategy to achieve the profitability for that hospital? Thank you, Pak.
So, Robert, I'll take the first question and probably leave the second question for Daniel to answer. So our Congo initiatives will continue to drive complexity. We've started working on it, and a large part of the ARPD growth that you see is really complexity driven. And of course, there's been a shift again favorably on the payer side. So these two things have added to the ARPD getting better. As you know, and we've said this in the past, we don't take any pricing decisions through the year. We work on our pricing once a year, which is in the first quarter. So therefore, any growth that is price-led will only be seen, in the first quarter, not on quarter and trailing quarter basis. Of course, there'll be an impact on quarter on quarter basis. As regards complexity, we are getting more focused in doing more work on complex surgery on the oncology side. We do believe there are still gaps that Indonesia needs to address. We need to address on catering to the entire spectrum of oncology. We do immensely great stuff on medical oncology, but I think there's more room in developing specialized surgical onco centers, and that's something that we are working on. we're putting a team together, we're putting the necessary supply side together to be able to cater to that demand. That demand will certainly help us grow our ARPD as well as ARPOB quite significantly. Same thing on cardiology. As you know, we spoke about our cardiology investments in the past. So we are looking at cardiology as centers of excellence, and we not only are adding complexity in our existing centers, but we are adding cardiology into many other hospitals as well. So that on a blended basis will again start to give us better complexity as we go forward. I alluded to this, but let me touch upon that again. We are very mindful on the work that we can do on digestive. And you will see us do significantly more stuff on digestive care, on liver. And I think that too will be adding significant complexity. So yes, it's a humble beginning, but there's a long way to go in terms of building more complexity on Congo and therefore delivering higher revenue contributions from Congo and better ARPOBs going forward as well. So I hope that answers your question. On the ramping up, the headline is that we don't have a category called ramping up anymore because we don't need that category, but I'll let my friend Daniel answer that.
Thank you, Varun. I think basically that definition that Varun just made is very important. Yeah. 3 years ago, we started segmentation of our hospitals, and I presented to you as a segment called ramping up. Yeah, to say that we're going to be razor focused in making sure that these ramping up hospitals as a group is going to turn profitable. I want to say that it's a mission accomplished. So that chapter has been closed. This year forward, we'll be presenting to you what we call the hospital archetype, whereby we start looking at hospitals in terms of premium, value seeker, and BBGS segments. We now no longer, even internally, have a segment called ramping up that we monitor because it's no longer relevant. Obviously, as we open new hospitals, we've always said there's a 2 to 3 years path to EBITDA positive. And that is a commitment that we're sticking to. So any point in time, there will always be some EBITDA negative hospitals because we will always be opening up new hospitals. But I think that number now is no longer relevant because the mission to make sure that this group of hospitals turn around and become positive, as I say, the mission has been accomplished. It is not the numbers that we will dwell on. We now want to really focus on what Varun has explained to you before. The Congo, how to improve complexity, how to double down on premium and improving our services and so forth moving forward.
Yeah, and maybe, Daniel, if I can add, I think in the recent past, the science that we have about opening new hospitals has also got significantly better. So our path to maturity or path to profitability for a new hospital that open is much shorter than what we've seen in the past. Willie shared, I think, in Q2, our experiences at Ambon. I don't know if Daniel remembers the number offhand, but that hospital was supposed to get profitable, I think, in the third year or something, as per our plan, and turned profitable in the first 9 months. And today we have a significantly higher profit pool coming from Ambon as a hospital than we had even thought. So I think that science also, or the learnings from our past, have made us significantly better.
Thank you, Pak Daniel, Pak Varun. Next question from Ingrid. I will allow her to talk.
Hi, Siloam team. Thank you, Willie, for taking my question. Hi, Pak Varun, Daniel. Congratulations for the very great result. So I have 3 questions. The first one, still regarding your cost dynamic, both in the COGS and OPEX, because I saw that your EBITDA margin saw quite a huge jump quarter-on-quarter wise, even though you mentioned that in the longer term that you've been doing the procurement initiative and OPEX initiatives, but in the quarter-to-quarter term, can you give some insight on what's happening there in terms of the cost? And I'll start there first.
I think, Ingrid, the quarter-on-quarter improvement is really a reflection of the long-term program that we're executing. Yeah. Obviously, I mean, if you look at the program, we have different, for example, let's say drugs and consumables, right? we started focusing on drugs, and then we focus on the top 80% of drugs, and then we move on to the next next 20%. We started then moving into consumables. We then started looking at leakages. We now are working on packaging and so forth. So again, there's no magical, well, we did something different from one quarter to the next. I think what you're seeing is a sustained program that is being executed month on month, really, and being monitored very tightly month on month, and which is why you're seeing that getting reflected in the quarterly results that you see. And I think the key that you see in here is that you're not seeing like, you know, one quarter I made an improvement, next quarter I go backward. The trend is really quite sustained. Obviously, some quarters the gain will be slightly bigger than other quarters, depending on what sort of program then get executed, effected, and so forth. But I just want to say all of that is really from part of the program, which is actually still not finished. It is still ongoing. So I would really expect to see further improvement going forward.
Absolutely. Ingrid, let me add to what Daniel said. So this is sustained. So a couple of things that may have impacted or has impacted quarter three is we've had significant upside or improvement in our diagnostic costs. We culminated a multi-year project. It took us about, I guess, about 5 quarters to really work with our diagnostic partners to be able to bring down our diagnostic costs quite significantly. And that impact has come into the third quarter from, right. Daniel, I think that was the first month of the third quarter that probably impacted us. So that's very significant. And I think just adding to what Daniel said again, we've also been very cognizant of trying to look at the mat consumption, not just the cost. Whether it's the BPJS business, whether it's our our own efficiency around the consumption that happens, which is non-charged at times, it's a part of the bill. We were also able to save quite significantly on that. So that has impacted our third quarter.
Sorry, can you repeat again the last part? What cost? Sorry.
So the two things that have impacted us or given us favorability in the third quarter, one is our diagnostic costs.
Yeah, and the second one?
Very significant reduction in our diagnostic costs.
Mm-hmm.
It's contracted, it is sustainable. So our costs will continue to be lower than they ever were in the past because we've had a multi-year contract with our diagnostic vendor. So that's one. The second thing is we are very focused on our consumption as well, not just the cost aspect of it. So we try and optimize. Daniel alluded to this, right? That we do a multi-year plan. So this is a sustained effort at all our units to be able to optimize the utilization for the BPJS patient, to be able to optimize the utilization of non-charged consumables, to ensure that we are more efficient in terms of our consumption. All of that is also, has also trickled down into this quarter P&L, and that number is also quite significant.
Okay, very clear part. And
so,
then next, yeah.
Ingrid, without going into specifics, so on the diagnostic part, I mean, we are basically now paying approximately 30% less compared to what we were paying before. Now, as Varun alluded to, this is multi-year, which means that whilst the benefit is realized in this quarter, it will be realized quarter on quarters going forward, right? And each quarter going forward, there will be different initiatives such as this that will be executed that will add to our overall margin improvement as we move along.
Okay, very clear on that part. My second question is regarding the revenue intensity. How I see it is usually using the average revenue per outpatient and average revenue per inpatient days. So just want to know on the average revenue per outpatient visit, it seems like it dipped a bit in the third quarter. So can you give some insight on that as well?
Yeah, sure. So it's not that. Okay, so let me answer the question more straightforward. So when the BPJS and value hospitals drive the OPD, you will always see on the blended basis some drop happening from ARPD standpoint on the outpatient numbers. It's very healthy because what happens is when we are able to grow volume in the hospitals that let's say are less profitable than the blended numbers, that drive gives you a lot of operating efficiency. That drive gives you significant conversion in the hospitals that don't have the level of blended conversion that we've been talking about. Willie showed you a slide. There are conversion ratios are about 3.1%. Now imagine there are hospitals that don't do that level of conversion for multiple reasons. Complexities hasn't been built, doctor availability hasn't been sorted. But as we start to see doctors coming in, we first see the upside happening on outpatient, and then the conversion follows. So I think it's that's what has led to a slight decrement in terms of blended numbers on OP ARPD. If you see our OP numbers have been fantastic this quarter. I think a 15% growth is what we've seen in quarter and trailing quarter. So we're actually delighted that we've been able to develop and grow this level of throughput. And if you see our historical performances, but for an exception of, I think, last year, third quarter again, where we were able to enhance the throughput high double digit, I think we generally stay at about mid-single digit from a growth percentage standpoint when it comes to quarter and trailing quarter. So it's been an exceptional quarter for us, and we're very happy that we've been able to grow the volume that much with a little delta, negative delta in terms of ARPD, which is driven because the mix of hospitals that have grown OPD could be more value.
Okay.
Yeah.
Understood. Yeah, understood. And then my last question is regarding your initiative for insurance and corporate. So yeah, so that your corporate and insurance mix drive has been up quite a lot compared to 2019. Can you remind us again, like how can you achieve that both on the insurance part and the corporate part, and which one actually drive more so that you can achieve so many insurance or corporate patients?
So multiple initiatives, difficult to tell you all, but the degree of partnership that we've developed, which is driven by what our sales team, business teams have been able to do. We did tell you that we added quite significantly on the sales and marketing side. With the number of people currently impacting businesses are about 6 times more than what they were in 2019. We've invested, and I think we spoke about this last time as well, we've invested in CRMs, which allows us to track our businesses. We've engaged with the top tier management of multiple corporates. If you remember, our corporate business used to come from about 200 accounts in 2019, and now we get business from as much as 5,100 accounts. We have corporate engagement programs, we have partner engagement programs, we have insurance engagement programs, and all of this is carried out in a very structured way. We also try and do annual events where we are able to bring the who's who of this country together. And kind of celebrate with them. We call it a partnership day. We talk to them about what we've done on healthcare, on preventive, on curative, what our programs are. We understand their needs. And that degree of programmatic work that we do with these partners, with the payers, I think keeps us in good stead. And we continue to gain their share of the market. Second, this is also driven by the consumer pull. We've gained a lot on our NPS, our Google scores. And we also see that our consumers love us for what we do because we have been able to create the right programs for them. Third is, of course, our digital interventions. The ease of access today that we are able to provide is unparalleled. So I think all of these are broadly reasons for why we've been able to grow the premium share of the market quite significantly, which is then funded by the corporates and insurers.
Okay, very clear, Pak. Thank you, and best of luck for the rest of the year.
Thank you, Ingrid.
Thank you, Ingrid. We have one last participant who raised her hand, Pak. I will allow Aurelia Setiabudi from BNI Sekuritas to.
Thank you, Willie. Hi, Pak Daniel. Hi, Pak Varun. Big congrats on your another record high quarter. I have 2 questions from my end. The first one is regarding the bed occupancy rates. Saw that the number is closing to the level of 70%. My question is, what is the plan regarding to this BOR, which is already closer to the optimal level? How many beds do you plan to add over maybe in the 4th quarter and maybe as we move into the 2024? I'll stop there.
Yeah, so great question, Aurelia. So one, thank you. We are in good, we are a good bore now at about 70% occupancy. And a good healthcare practice would be when blended level you're at 70 odd percent, you start looking at a network, you start looking at where the expansion is and stuff like that. So there are three relevant points to this, and maybe Daniel can also add. The first relevant point is that we've only currently operated or our operational beds are close to 4,000. So when you look at BOR, you're looking BOR as a percentage of only those 4,000 beds. And our built capacity is about 8,000 beds. And even if we don't consume the 8,000 beds, we can safely go up to about 6,500, 7,000 beds from a built capacity standpoint. So it's not that we need to add capacity, we just need to open capacity. Now, opening capacity is something that we're very mindful of because ours is a seasonal business, right? So 70% blended doesn't become a cause of concern. We look at it every quarter for each hospital. Any hospital that starts hitting 75-80% occupancy, we start to look at what to do around capacity with that hospital. So it's a very continuous process that we look at. For quarter four, we are looking at expanding some beds. There's already a plan in place. There are CapExes which have been approved and work is happening. We can give you details offline on account of what we are adding in Makassar, how we're building more towers, what's our plan around Jakarta, addition of beds. We're adding some beds in MRCCC. We're adding a little bit in Simatupang. We've just added 2 floors in some of the other hospitals. We've operationalized a few floors for mom and child, in some other assets. At Lippo Village, we're adding capacity both in OP and IP. As we told you last time, that we do feel that there is a very significant need of expanding oncology in Lippo Village. So we're adding that, we're adding bunkers there. So there's a whole lot of stuff that's happening around our network to one, increase capacity, to increase and enhance the clinical programs which are required by each hospital. So we are very mindful of it. And if you want details, Willie can Willie can help you with an offline conversation.
Thank you, Pak Varun. That will be very helpful. My second question is regarding the construction of the new hospitals. If you don't mind to share any updates regarding that part.
Yeah, sure. So lots happening there as well. We have been very cognizant, as Daniel mentioned, we don't open too many hospitals. So the plan is again to open 1 to 2 hospitals a year. And this time, Aurelia, the plan is to be able to focus on the premium hospitals, right? So currently, we are focusing on getting our Surabaya off the ground. Our Surabaya building will be one of the finest assets that we are building in our network. So that's one. 2, we announced Kemang last time to you all. It's a market that we do believe we can do a lot more. So that's underway. I don't know exactly as to how much has happened, but I'm sure we've done the required necessary stuff to get that off the ground. Again, Makassar is another big piece because we are adding a tower by itself in Makassar. And that will not only add capacity, that will allow us to add a very significant clinical program, which is the need of the market as well. Daniel, I may be missing out a few of the build-ups.
Yeah, we're also working on Bandung, another key markets for which we do not have a presence currently. Next year, you'll probably see the opening of Surabaya Cito. Surabaya, I think, is a market that we are underrepresented. Varun mentioned to you that the current existing Surabaya hospital, there will be a flagship being built next to it. But at the same time, we also want to have more hospitals in those markets.
Noted. Thank you so much for your explanations. I wish you all the best for the remaining of the year.
Thank you, Aurelia.
All right, but we don't have anyone who on the question list. So I think that concludes the call. So let me thank you, Pak Daniel and Pak Varun. That concludes our call for today. And thank you for all participants who joined the call. And as always, if you have any follow-up questions, please reach out to me anytime. We wish you a good day, everyone, and we'll see you on the next webinar.
Thank you, everyone.
Thanks, Dan. Bye.
Bye.
Thank
you, Pak.